Okay, so we continue discussing about the accumulation, decumulation, combined glide path.
Okay. So, anyways, I would not be opposed to even 100% equity portion if you still have 10 years to retirement. Because remember, timing when the next bear market happens is incredibly difficult, right? If the bear market is right around the corner, yeah, then by the time you reach retirement in 10 years, you probably recovered most of it again. And then your new contributions, you put in your new contributions that where you capture the dollar cost averaging along the way. So you might keep 100% equities if you still have 10 years to retirement. I don't think it's a completely crazy assumption, especially, and again, this is all hinging on not doing Monte Carlo simulations, right? Because Monte Carlo simulations, you have a 50% drop, boom, it's going to take you years and years and years to dig out of that. And whereas in real historical market data, usually just the way the market overreacts on the upside sometimes, right? That's year 2000, 2001, potentially today. It will also overreact on the downside, right? I mean, we had the market was so beaten down in February and March 2009 that I mean, the valuations looked insanely attractive at that time, right? If you look at basically the market was pricing in almost like an event as bad or worse than the Great Depression in terms of the drop and the persistence and the length of the drop in earnings. And of course, earnings recovered relatively quickly again after the global financial crisis. So the snapback in the market was a lot faster than anything that can be done in a Monte Carlo simulation. So again, if you believe that we're going to have a bear market, but the bear market, it's going to overreact a little bit on the downside, and then it recovers again. I think you would benefit from a much higher equity allocation. I mean, you definitely want to be above 50%, want to be probably at least 80%. And if you're a laid back guy like me, and you're not too scared about the equity market and volatility, you might even go 100%.
Cool. What do you think of a glide path from a risk parity all-weather to an all-equity portfolio, and which do you consider being the optimal glide path?
So again, it goes back to the idea. First of all, I like the idea of a glide path, right? So you start with diversifying assets, and then you move back into the more risky assets, and that takes off a little bit of the edge of sequence risk. And then people obviously say that, well, because bond returns are relatively low, can you give me something else that has a little bit less risk, but potentially better returns than just U.S. Treasuries? And so risk parity, there is not one single risk parity approach, right? So basically what you do in risk parity is you, instead of assigning weights according to each asset class, I say, well, I take 60% weight in stocks and 40% weight in bonds. You do this by how much risk contribution you have to the portfolio from the different asset classes. And so it's definitely a very intriguing approach. What I don't like about risk parity is that it's actually a step back. It's a dumbing down of lessons that we already learned 50 years ago, right? I mean, we have modern portfolio theory, and we have how do you optimize a portfolio? You look at expected returns and risk, and then you have some kind of a mean variance trade-off, and you have and you find an optimal portfolio doing a trade-off between expected returns and expected risk. And so the risk parity approach is essentially a dumbing down of that approach, because now you start ignoring expected returns and you only look at risk. So, and then what normally happens is that if you look at a typical risk parity portfolio right now, it will have way too little exposure to assets with historically high realized returns, and then also going forward, high expected returns going forward. And you have a lot of assets like commodities, bonds with extremely low returns. Now, it's obviously good, right? Because that gives you a low risk and a very good diversification against equity market volatility. But this is a portfolio that will not sustain your retirement for the next 50 years. So you have to shift out of that risk parity into a more traditional portfolio to survive a typical retirement length of, say, 30 years for a traditional retiree and 50 to 60 years for an early retiree. So I generally like the idea, take something low risk, shift into higher risk. I just don't particularly care for risk parity, especially, I mean, it has gotten a lot of publicity, and people got really excited about this. A lot of the risk parity appeal came from, I mean, it obviously did very well over the last 20 years, right? You get that, you get that duration effect from bonds, right? Commodities also did spectacularly well during the 2000s, right? And so you look at some of the returns from risk parity during that time, you thought, oh my God, I mean, this is like we invented the license to print money here, right? But just like everything that looks really good over short horizons, it definitely lost a little bit of its luster. And again, I mean, I like to understand not just if something does well or does something doesn't well, but I also try to understand why, right? And as obviously risk parity, it did very well. It was riding this bond wave. We have this now 40-year bull market in bonds, so that obviously helped a lot. I mean, if you do risk parity, it might stumble a little bit if we have say increase in inflation, increase in yields. So you again, I like the idea, low risk, low correlation with the stock market, and you roll out of that. If you follow this approach, just make sure that you don't get stuck in some of these low return assets for too long.
Yeah, and let's not forget that bonds were called certificates of confiscation in 1970s.
That's right.
So going forward with so low yields, and maybe they're not even a very good diversifier anymore in inflationary times.
Right. So, and again, I mean, I was almost confident that so before the pandemic crisis, I assigned a pretty high priority and probability that the next recession will look more like the 1970s and less like the global financial crisis. And then it turns out that the recession in 2020 looked like nothing we've ever seen before, right? So in fact, in terms of the stock bond correlation, it was just like the global financial crisis again, right? Stocks go down, bonds go up because yields are now so low. In a lot of other characteristics, the two recessions were very simple, very different from anything we've ever seen. We've never seen a 2-month-long recession in the US, right? And we've never seen a recession that was very deep. And then we had a recovery at a 30% annualized growth rate in the third quarter. So a lot of things worked out completely differently in 2020. But I maintain, I think there is some probability that the next recession again will look more like the 1970s and early 80s. And as a hedge against that, yeah, I mean, maybe be a little bit careful about bonds. So maybe some other diversifying assets like real estate, gold might work better in that next recession.
Great. Let's now move to the last part of our interview, discussing about cash flow in retirement. Mm-hmm. Which are your views on the deleveraging process, which might be catastrophic for the markets? Are there any layers of protection to safeguard your portfolio in such an environment, like maybe earning cash flow from your rental income or having a farm and growing vegetables?
Okay, so first of all, I mean, what is is the deleveraging, is that the cause of the blow up, or is it a result of the blow up? Right? I mean, obviously we are going to have another bad recession going forward, and during that time we're going to have a great deleveraging, both on the household level and on the corporate level. I don't think that I would prepare anything for something specific to a deleveraging, right? I would prepare for a bad bear market. And again, that could come as an inflationary shock or a deflationary shock. And so be prepared for that. The deleveraging, I think, is more of a side effect of something that might happen. It could be a housing crash again. It could be. It could come from a number of different things. I mean, remember when the Great Depression happened, or when the global financial crisis happened, right? It was something that nobody had ever considered. Everything becomes really obvious afterwards, but nobody would have expected what was the source of the crash. And so I wouldn't focus so much on the deleveraging itself, right? I would focus on what does it mean for your portfolio. Our stock market is down. Probably the bond market could be up, could be down. So I would focus more on that. And yeah, I mean, as you said, probably real estate might be a good hedge, obviously against the inflationary shock. I think even a deflationary shock, because I mean, what you see is that if you have a deflationary shock, you're going to have normally record low interest rates. That's good for housing too, right? Because that drives up all of your non-traditional asset classes. So we've had a pretty good housing market here, and that whether it's inflationary or deflationary, I think the housing market will do pretty well. Again, the one exception is the global financial crisis, but I know a lot of real estate investors that did phenomenally well during the global financial crisis. So all you needed to do is you wanted to be not the dumbest guy that bought at the top, and then you levered it up so badly that at the bottom you needed to liquidate your assets because your financing fell through. If you played this a little bit smart and you played it conservatively, and you buy and hold real estate, and you don't have to sell it, you don't over leverage it, I think that actually real estate would be a very good hedge. Now, I'm not sure if I would go all the way to the farmland and growing your own vegetables. I mean, it depends on what kind of crisis you're trying to hedge against, right? I mean, if you're trying to hedge against total breakdown of civilized society, I mean, then all bets are off. Then forget about financial assets, anything that's in electronic form. And then, by the way, Bitcoin doesn't work there either, right? If we have something like an EMP, electromagnetic pulse attack, that takes out all electricity and all electronics, then your Bitcoin is fried too, by the way. So in that case, maybe farmland is the way to go. But I'm not there yet. I'm not seeing that risk yet.
I would say that in Romania, people are prepared for a deleveraging because they don't invest in financial assets because they don't know what investing is, and they over-leverage real estate because they heard from Robert Kiyosaki that this is great because cash is trash, savers are losers, and this is how money is made.
No, and I agree. Right? I mean, real estate is already a pretty decent asset, unleveraged, right? And now you look at what you can do with a little bit of leverage. I mean, you can get spectacular returns. Probably, I mean, as I said, right, it took me quite a long time to 5x my money with the stock market. And again, you could have done it better if you had invested in Google or Amazon or Tesla, right? But say with the broad market, it's not that easy to 5x your money, right? It took me maybe 12 years. Now, with real estate, that's certainly possible within a relatively short amount of time if you use enough leverage. But then again, keep in mind, it killed a lot of people in 2008 and 9. So so you have one you have one property, and then you lever that up to buy your next one, and then you lever that to buy the next one. And then if something happens, say you have a recession, you have some tenants not paying their rent, so that's definitely a concern. But if you play real estate, if you play that well, you have to find that sweet spot where you have enough leverage that you pump up your returns, and you have not so much leverage that it's not going to wipe you out in the next crisis. For example, I invest in real estate, but I don't invest myself. I do that through some funds, and these are truly real estate funds. So this is not a REIT. This is not an ETF. So this is a private equity fund, and so we invested in several of these, and so they collect a certain amount of money from investors, and the most recent one, they collected a total of almost $200 million, and then they go out and then they start shopping for multifamily housing. So these are not single family, but large apartment buildings. And yeah, I mean, they do very well. And they told me, oh, we did very well in 2008 and 9, because they actually did well picking up some of the quote unquote trash from people that got wiped out in the global financial crisis. So they needed out, they had to liquidate their holdings, and then they bought them. So these funds could buy properties for maybe not pennies on the dollar, but maybe for 70 cents on the dollar. And so yeah, I mean, absolutely, I like real estate, but it's a very peculiar asset class. I don't want to do it myself, and then because I have to outsource it to somebody else, it's not like I'm going to hand over massive amount of money to these guys because, hey, I mean, I trust them, I know them, some of them I know personally. But there's still that issue. I can't see everything. I mean, I can do a little bit of due diligence and background checks and see. I mean, of course, you can do some background checks and check if they actually own the properties that they claim they own, right? I mean, you can check the property tax records of some of these properties, and then, okay, yeah, I mean, this is owned by Reliant Capital Group, and okay, so that's good to know. And but yeah, I mean, I wouldn't invest massive amounts of money in there, but I definitely like to raise my percentage to that asset class. I think that's it's a good way to go, and it's stable, and I think it's a very profitable asset class, especially for people who know what they're doing. And again, I mean, I'm not an expert, and I have to pay these guys a little bit of a management fee to do what they're doing, but I think they're worth it. They definitely add more value than I pay to them in management fees. That's for sure.
Another popular cash flowing assets are dividend yielding stocks. Dividend growth investors often disregard safe withdrawal rates because they believe they can live off dividends. Do you think that dividend yields can ever be a replacement for safe withdrawal rates?
No, and I've had lengthy discussions about this approach, and I think it's a very foolish approach. And so, first of all, let's distinguish between two separate flavors in this whole community. Right? Let's look at just the dividend style, and then dividend style plus stock picking within that style. All right. So if we just look at a style picking first, so do dividend stocks add anything to your safe withdrawal mechanics? So imagine we shift away from the broad market, right, S&P 500 index. We can also shift to something that is still relatively passive, but is doing dividend stocks. Right? I mean, for example, Vanguard has a fund, VYM, Victor Yankee, M as in, what is it? Marketplace. I'm just making that up. So VYM. And how did that fund perform recently? And so we have returns going back all the way to pre-global financial crisis. And turns out that VYM ETF actually even slightly underperformed the S&P 500. And again, this is both the S&P and that VYM fund. I consider the total returns, right? The price return plus dividend yield. And so it didn't really do anything in 2008 and 9. It actually detracted just very marginally from your performance. And then most recently in 2020, that fund vastly underperformed the S&P 500. So it didn't help you in that market crash either. So it doesn't look like that just shifting to a dividend style is going to vastly help you in terms of your safe withdrawal rates. And so, of course, this dividend focus you're a little bit lying to yourself, because obviously dividends, they can be cut, they can stagnate, right? They can stagnate so that if you want to withdraw just the dividends, then, well, your withdrawals might not even keep up with inflation. So a dividend is not any kind of contractual agreement, right? So the companies can and they have cut their dividends, right? And so, of course, the dividend crowd is going to say, "Oh, no, I mean, because you're doing it wrong, right? You can't do just the passive index fund, right? Because what Vanguard is doing is, this is not an active strategy. So what Vanguard is doing is, instead of doing a market cap weighting, just like the S&P 500 index funds or the total stock market funds, they weight the stocks by how much they pay in dividends, which is still relatively passive, because the weights are not going to change all that much. But there's a little bit of trading involved in managing that. So what the dividend crowd is now going to say, wow, you can't go with this passive fund. You have to pick the good dividend stocks and the stable dividend payers. And then there are all sorts of dividend aristocrats and dividend princes and dividend kings and there's all sorts of additional ways of screening stocks in this dividend universe, right? Where they look as well, you can't just go with stocks that pay a high dividend. You have to go with stocks that have been paying consistent dividends, have been raising their dividends every year. But then again, now we are wading into stock picking, right? And if you remember your discussion with Rick Ferry, you're not going to beat the market that way, right? I mean, just be serious. Especially considering that, look, I mean, you are up against other active professional investors that are stock pickers, that are looking for where are cheap stocks that we want to invest in that will go up more than everybody else. And so it's not like by looking at just dividends, you suddenly have the secret sauce for becoming an active investor, right? I mean, think about it, it's almost laughable to believe that you are the only ones looking at dividend and dividend yields and dividend consistency and dividend growth rates. That's all being looked at by all of the active investors all over the world. I mean, you're not the only one looking at this. And the prospect of you finding better returns through dividend stock picking, and I mean total returns, right? Dividend plus price return. The prospects of that happening are pretty slim to none. And I just want to give you one example, right? If you look at some of these dividend aristocrats, you can obviously look at what the dividend aristocrats are today, and you will notice, I mean, these are all stocks that have performed really very well over the last number of years. Now, the problem is there's a survivorship bias, right? I mean, what about all the dividend kings and dividend aristocrats that somebody might have held along the way that then dropped out of the dividend aristocrat crowd, right? I mean, what happened to them? Well, what happens to a stock that was considered a dividend aristocrat and then stops paying a dividend altogether or cuts their dividend by 50%? I mean, they're going to get clobbered, right? I mean, first of all, you have a lower dividend. And then what do? Do you sell the stock at that time? Do you hold on to it now that it's paying a lower dividend? I mean, this is really a damned if you do, damned if you don't, right? To pick your poison. And I look back at who were the dividend aristocrats back in 2007. And yeah, I mean, a lot of dividend aristocrats were banks, as financial companies, because they were considered very solid dividend payers, very solid business models, very profitable. Yeah, and then they got clobbered during the global financial crisis, right? The Bank of America, I don't think they ever completely eliminated their dividend, but I think they went down. The dividend went from 18 cents a quarter to 1 cent a quarter, and they stayed there for a very, very extended period. And so the stock price was down, the dividend was down. And so again, I mean, what may look like a very solid dividend payer today might become the worst stock, might become your worst nightmare. I think GE used to be, as a General Electric, used to be a very stable dividend payer, and I think then they had to cut their dividend at some point, and they also got clobbered really badly. So think about it. I personally don't think that dividend tilt, neither on the index level nor by stock picking, is really going to add anything. In fact, in 2008-9. It even subtracted a little bit from your performance. It vastly subtracted from your performance in 2020. So I was never a fan of it, and I'm not saying that dividends are bad. I'm just not saying that they are better than the index. And I wouldn't short dividend stocks, right? I'm not saying that they are bad. I'm just saying that they are not better. And so in that sense, I mean, I wrote extensively on this issue. I mean, I wrote 3 blog posts, the Safe Withdrawal Rate series, parts 29, 30, and 31, where I debunk some of these arguments well, can't we just increase the yield of our ETF portfolio and then not have to worry about sequence of return risk? And that kind of strategy would have catastrophically backfired in 2008-9. And the nice thing is, I wrote this before the 2020 episode. And then I was almost afraid that, hey, I now bash all of these dividend strategies, and then the next recession, the next bear market comes around, and then they do better. I would have looked a little bit bad. Again, it's not like I would have been wrong, but because I never said this dividend yield and pumping up your yield is bad for you. I'm just saying it's not better for you, right? I wouldn't bet against that either. But I was actually feeling really nice that even in 2020, again, this pumping up your yield strategy was not doing very well in that bear market. So we now have already 2 bear markets back to back where this dividend strategy didn't do very well. So that's why I'm not a fan of it. And my line of reasoning is probably very similar to what Rick Ferry would say, but again, my personal little flavor. But probably 90% is the same philosophy as Rick Ferry.
Yeah, I have also written an article why dividends are not passive income, and all dividend lovers have said that I'm a hater. And why don't I think there may be different strategies, and all of them can work? Not my strategy, but also theirs. So somehow they really believed in this idea of a yield shield, let's say, from dividends.
Right. So again, so that yield shield is what I specifically try to debunk in those 3 blog posts. But again, I mean, people are obviously very emotional about this. They dedicate a lot of time, and then people like us, we trample on all of their beliefs. So it's again, I mean, I don't want to bash them, right? I'm not saying that what they're doing is worse, right? I personally believe that dividends versus capital gains, I mean, it's both money. I like both, and what matters for total returns is basically the capital asset pricing model, right? If your stock has a higher beta or a lower beta, that has a higher expected return. So if you give me 2 stocks, one with a high dividend yield, one with a low dividend yield, they have the same beta, and then potentially some of the same other pharma French factor exposures. My personal forecast for expected returns would be that they both have the exact same expected return, even though one has a dividend of 5% and the other one has a dividend of 0%. So I would say that's what matters. Cap M plus some adjustments matters. The dividend yield itself is probably irrelevant.
And also, if you think about efficient markets, all assets should have the same risk-adjusted returns. The problem with individual stocks is that also they have idiosyncratic risks, and not only systemic risks. So if you want to, let's say, take more risk, at least do it in a diversified way, like an ETF or something.
Right. And then I would almost be afraid that some of that idiosyncratic risk might then also be correlated among all the different dividend stocks that you have in your portfolio, right? I mean, this would be risk that is not yet captured by some of the major factors like the market and then small cap value and the like. So you might actually have a lot of stocks with a lot of idiosyncratic risk, and on top of that, they might also have potentially some correlation among their idiosyncratic, because the stocks that you might pick up that might have some other hidden factor that people haven't thrown yet into their factor model yet. So yeah, I mean there's a ton of philosophical, economic, financial, statistical reasons not to get too excited about this dividend yield stuff.
Yeah, if we think about the Modigliani and Miller theorem, yes. We know that dividends are irrelevant in investing, right, then may earnings yield be a yield shield?
Again, it depends on how you use it, right? So I wouldn't use it for stock picking, right? Because all of the same caveats apply here again, right? So earnings, just as dividends, are probably some of the first measures that active stock pickers will look at. And if an earnings report comes out, if you're not acting on that within a millisecond and trade on that information, you're going to miss the boat. And then by the time you look at the earnings yield of an individual stock, all of that information is already priced in. So again, I wouldn't use it for stock picking for the exact same reasons as we talked about it on the dividend topic. But again, obviously on the index level, I like to look at earnings yields to guide me in terms of potentially the safe withdrawal rate, and then also potentially the tactical asset allocation, stocks versus bonds. But again, on the stock level, I don't think that's a very fruitful approach, because lots and lots of people will look at earnings already, and then every possible variation of earnings, right? I mean, so for example, they will have access to earnings data that you don't have, right? I mean, so for example, past earnings are in some way water under the bridge, right? What really matters is the earnings forecasts, right? So you would have to have access to the analysts and their little spreadsheets where they estimate, say, the earnings forecast for ExxonMobil and the earnings forecast for Chevron. And so it's not so much the past earnings that matters, it's the future expected earnings. And there might be some data that's relevant that you don't even have access to as a retail investor. So again, I mean, I personally don't think that we should dabble in that, because you're up against too many professional investors that have they can trade on the information much faster. They will have access to information that you don't have.
What if we take into account the global index tracker, FTSE All World, and we calculate the cyclically adjusted earnings yield? Would it work as well as a safe withdrawal rate without any other formula?
No, I mean, it works or it doesn't work for the same reason as, so for example, if I took the CAPE yield of the S&P 500 and I use that as my safe withdrawal rate, there would be all sorts of problems with that approach, right? So it's probably way too low right now if I do that one for one. So same thing with the FTSE or the MSCI World Index. I can obviously get the CAPE for that. Yeah, I mean, I would like to have a CAPE, the formula that takes the CAPE, that translates this into a safe withdrawal rate, where I'm between the two extremes, right? I want to have a safe withdrawal amount that is somewhat responsive to market movements. So if the market drops, I also withdraw a little bit less, but I don't withdraw exactly one for one less in terms of the percentage drop, because I want to have this mean reversion aspect of where markets will eventually return to a long-term growth path, and I don't want to overreact. For example, if we find ourselves again back in a situation like in February 2009, right? I don't want to withdraw such a small amount when the equity market is so beaten down and it potentially has an extremely high expected return. So I would probably not do it one for one, but yeah, I mean, you find some formula that you're comfortable with that doesn't fall into neither the fixed withdrawal amounts, inflation adjusted, nor that fixed percentage rate where your portfolio and your withdrawals have the same volatility. You find something in between. I think that's always preferable.
Most early retirees often begin their retirement spending right after a bull market, when they usually hit their target goals, thus increasing the likelihood of failure rates. To alleviate this risk, should they add a supplemental income such as a side hustle or I don't know?
I think a lot of people do this, right? I mean, even a lot of traditional retirees, right? I mean, they will quit their job, but they still work, say, as a consultant for that same company, maybe for a few more years. I certainly did that. So, for example, I left my job, but I still got a little bit of deferred compensation from my old workplace. So I still got 3 more years worth of bonuses paid out after I left the company. And then, I have a blog. I make a little bit of extra money with my blog. I currently do a little bit of a teaching job. It's all online, so that's really nice. So it's absolutely, it sounds really attractive. So I think that it's both from a financial point of view as well as just from a social point of view, right? I mean, there's a lot of people might feel lonely and empty and bored in retirement. And I say, yeah, absolutely. If you can make a little bit of extra money, why don't you become an Uber driver, or you still do some consulting for your old company? It keeps you engaged. It makes the transition easier. And then also you have that little bit of supplemental income. And what I like about that is, because we talked a little bit about this, can't we have this a little bit of this cash cushion that hedges maybe the first few years of your retirement? You cover your mandatory expenses. But yeah, with bond yields and interest rates and money market interest rates so low right now, it's probably the better route to just generate a little bit of extra income to deal with this, so you don't have to waste your portfolio on something so unproductive as a money market account or a certificate of deposit. So I mean, I totally endorse that, and a lot of people in the FIRE community are definitely doing that.
So you're not actually a supporter of having a cash cushion in retirement right now?
Well, again, I mean, the past historical simulations support that idea that it's obviously it's just like any other insurance, right? So if I pay for car insurance or we insure our house, I know the expected return of that payment is negative, right? What I pay in is less than what I get out in expected terms. But the nice thing is, conditional on getting something out, it's correlated with something. Well, yeah, I get money out, so I'm not losing my house if it burns down, right? I get money back if the car is totaled or the house burns down. And it's the same thing with the cash cushion. 99% of the time, it's a bad investment. So you have the opportunity cost of not having your outsized equity returns. But on the other hand, in the 1% of the time when that cash cushion works and is a good financial proposition, just exactly in that time, it works well, and it works well in the really bad outcomes of the world, right? So it increases your fail-safe withdrawal rate a little bit, but then it takes a little bit away of the prospect of, say, you will have less of a prospect of tripling your net worth throughout your retirement, but you also take a little bit away of that tail event.
Larry Swedrow has once said that you have to ask yourself whether you are a stock or a bond, referring to someone's income. Do you think there should be any correlation between someone's active income or also his net worth and his asset allocation portfolio?
Yeah. So I totally support that. And by the way, I don't think that's his idea, right? I mean, this is something that this entire idea has been around for, I think, as long as economists and finance has been around. So the idea here is that so you should ask yourself when you accumulate, what kind of industry do you work in? What kind of job do you do? And is the income from your job, is that more like a bond or a stock? And so, for example, a lot of people who work for the government, even people in healthcare, they probably have jobs that are relatively recession-proof. There's one little exception that some healthcare providers lost some income during the pandemic crisis. But normally, recession or not, when people get sick, they have to go to the doctor and they have to get treatment. On the other hand, you have people like when I worked in the finance industry, right, I had a relatively volatile job. Our business model was explicitly linked to, in many ways, to the stock market, right? If the stock market was doing well, we were doing well. And if the stock market was doing well, okay, I had a fixed salary, but my bonus would depend on how well the firm was doing. And the job prospects, right? The prospects of either being laid off or staying on the job or being promoted, right? That was also depending on performance and also the market performance, right? So we had almost every year we had waves of layoffs, and fortunately I was never impacted by that. But I mean, obviously, if the market had not performed as well post global financial crisis, I probably would have also faced the risk of layoffs, or sometimes layoff just one person, or sometimes the entire floor is let go, right? I mean, there's some horror stories from the finance industry. So obviously, so my job and my income, I think it was still a bond, but it was a bond plus some stock exposure, and some other people probably have more of a income profile that looks more like a bond. And I think absolutely that should matter in your asset allocation. So it matters in your asset allocation in multiple ways. So first of all, if you have a relatively safe and stable job, absolutely you should invest pretty much, especially early on, 100% in the stock market. So don't worry about 60-40 or 80-20. Funny thing is, even I, with a relatively risky job, I was always 100% stocks. Don't recommend that necessarily that everybody replicates that, because just because it worked out for me doesn't mean it will work out for everybody going forward. On top of that, so what I find really beautiful about this concept of thinking about your current earnings and all of your future earnings as almost like payoffs from a bond, or think about it as basically zero coupon bonds that expire in all the years for as long as you plan to work, right? So consider that as almost zero coupon bonds. And what I really like about this concept is that exactly makes my point. You should be 100% equities when you just begin, right? Because you have all of this implicit bond exposure, which is your income. And with all of this income, even if you invest 100% in stocks early on, and you put, say, you put your first $1,000 into the stock market, and then another $1,000. At some point, you have $10,000 in stocks. But imagine you make $50,000 a year, and that's another $500,000 over the next 10 years. Well, a little bit less if you discount the future, but you're still talking about numbers in the hundreds of thousands. If you have hundreds of thousands of dollars in implicit bond exposure, you shouldn't worry about putting any more bonds in your retirement portfolio, right? Keep that as 100% stocks. But then there will obviously be a crossover point, right? Where you get closer and closer to retirement, and that implicit bond portfolio becomes smaller and smaller. Then you will start this glide path down from 100% stocks to something a little bit more more palatable and with significantly less equities. But yes, I absolutely support this idea of thinking in terms of your entire portfolio, right? So your portfolio is not just your investment portfolio. You also have human capital, and that human capital generates something that looks mostly like a bond. And then for some people, it looks like a corporate bond for some other people. And then maybe for some other people, if you're really, really risky, maybe it looks like a preferred share. And then for somebody really, really, really exposed to a lot of risk, then it looks more like a stock. Again, I mean, I hear from a lot of people, right? I mean, they're government employees or medical doctors. I said, I could never invest in the stock market. It's way too risky. And I said, well, yeah, you should. You have a lot of bonds already. That's your labor income. Why don't you do 100% stocks now?
What if the opposite is true? Let's take an example of someone who receives an inheritance. Let's say he's coasting to retirement. He has 10 more years until reaching early retirement. He has a substantial nest egg, but doesn't have any more savings. Should he or she still be 100% in equities in this case, especially in an overvalued market like this?
No. In fact, I think now you're almost back to the very traditional portfolio optimization, because without any additional contributions, right? So you set that implicit bond exposure to zero. Yeah, I mean, now you probably look at something like an efficient frontier diagram, right? And you look at, here's the stock expected return, expected risk. Here's the bond expected return, expected risk. You map out this parabola along the way. And yes, absolutely. I mean, chances are you will not be 100% stock. So you might be something like 75-25. If you're really, really risk averse, it might be 60-40. But again, remember, if you tell somebody, people complain about expensive equities, right? But then if you take, again, I mean, the equity market still has a pretty decent expected return, probably somewhere around 5, 6, 7% nominal return going forward over the next 10 years. Maybe 3 to 4% real return. I mean, you plug a 60-40 portfolio into that, where 60% is maybe 3% return, and the other 40% is something like minus 1% real return. And you look at the expected return that comes out of that. I think I could convince that person, hey, I mean, 60-40, don't you think that's a little bit low? You're down to, I think you're probably at about 2%. Probably you might even be below 2%. I don't want to do the math on the fly here, but so you do 0.6 times 3%, that's 1.8. But you do 0.4 times minus 1. So you have an expected return of 1.4% in real terms. So 60-40 doesn't look that attractive. So you might, it's this conundrum, right? So if all of the returns all shift down, right? Stock returns, expected returns are low because the CAPE is so high, but bond returns are also really low because the yields are so low. you might get into this very ironic situation that because everything is so expensive, you now have to boost your returns somehow, and you have no other choice but to go a little bit higher risk, especially considering, the stock market has been doing pretty well recently. Right? I mean, if you think about it, how well it recovered after the global financial crisis, we had a bit of a drawdown during the pandemic, but then money rushed in so quickly again, and it recovered so quickly. Yeah, maybe if you just look at the daily volatility and the monthly volatility, it's still the regular 15, 16, 17% annualized volatility potentially. But the drawdowns over the last 12 years have been relatively easy to stomach, right? And haven't had another 50% drawdown, right? 50% drawdown, and then you stay down there for multiple years, and then it takes multiple years to recover. That hasn't happened recently, and it looks like, because everything is so expensive, even if the market goes down a little bit, it's a lot of money is rushing into the market, and people are saying, okay, now stocks are on sale again. Now I come in. So it's a low expected return for equities, but maybe also not as much risk. So this looks attractive.
Maybe the most conservative approach in this case would be a 30-70 equity glide path proposed by withdrawal.
Yeah, possible.
My last question for today. Does it matter whether you fund your retirement every month instead of once per year?
Again, so I personally always paid regular contributions into my retirement account, but I did have some lumpy contributions because when I worked in finance, you get a year-end bonus, and the year-end bonus was usually paid out end of February. So I had a mix of two, right? So I had regular contributions throughout the year, but then also every year I had a big lump sum in February, late February, early March. And so a simulation I've been doing is that it probably doesn't matter how frequently you fund. So and then, by the way, also when you withdraw money, right, that's the other question, right? Does it matter whether I withdraw one big lump sum at the beginning of the year and then nothing throughout the year, and then I live off of that money, put that into a money market account, or I do it quarterly, or I do it monthly? I was actually surprised how little of a difference it made whether you do monthly withdrawals versus quarterly withdrawals versus annual withdrawals. So it's both in the accumulation phase and also in the decumulation phase. It doesn't really matter too much how you contribute. What I always recommend is when you have the money, just put it in. Don't try to time the market. So automate your savings. It's just because I had this constraint that I got a certain lump sum every year at a certain time that I faced this big lump sum investment. And if I had found a way to smooth that out, I probably would have smoothed it out. So what I always caution about is don't hold money back and say, well, I'll hold this money back and I invest it if I find a better entry point, right? Because there are people who did that, and they're still waiting for the S&P 500 to drop back to 2,000 points, right? And so once you start that, it's very easy to fall off the wagon and try to now is not a good time to invest money in the stock market because it's so high, and I wait until it drops a little bit. So don't do that. I think it's always best to automate your saving. Once the money is there, just put it in. So don't try to fiddle around. Okay, I'll put in maybe only 1/12 this month, and then I'll phase it in over time. Unless you get an inheritance and you make $3 million, maybe you don't want to put that all in at once. But say you get a bonus, just put that in when you get it. Don't try to overthink it, automate it, and take the little bit of the psychology and emotion out of it.
Right, thank you. Karsten Jeske, thank you very much for participating in our investing podcast. I'm pretty confident that many members of our Romanian personal finance and investing community will start right now enjoying reading your blog earlyretirementnow.com, where they can learn more about sequence of return risk, safe withdrawal rates, and equity glide paths in retirement. Now, famous last words are yours, Big ERN.
Yeah, thank you for having me, and I hope we can spread the word about how to retire early, what it takes to accumulate assets, what it takes to decumulate assets, and I think it will never become a mainstream movement. So I think it will always be a niche. Not everybody will do that. In fact, we would run out of people to work for everybody, right? So I think the economy actually needs 99% of the population to not do FIRE. So for the rest of the FIRE community to live in comfort while everybody is working. I'm very glad that this is catching on in other parts of the world. And so especially in Europe, and I'm from Europe, I'm from Germany, obviously. So I'm glad that people over in the home country and home continent are also interested in this. So best of luck with that.
Great. I'm glad that we had the chance to discuss today, and hopefully we can repeat the experience in the not too distant future. Thank you very much, sir, and all the best.
Thank you. Thank you. Thank you.